Well, so you have your promissory note, right? It's the agreement that you sign whenever a loan is taken out. Now, when you take out student loans, you sign something called a master promissory note. And the master promissory note is the promissory note for all of your student loans, so that you don't have to keep signing them every single year. As long as you're with the same institution, the same bank that's loaning you, you just sign the one, and that's it. Principal is the money borrowed. Annual percentage rate is the interest paid per year. We have APR with a bank account, which is the interest earned, and you have APR with a loan, which is the interest paid. Cosigner. If someone cosigns for you, or if you co-sign for somebody else, you need to understand that that is an agreement that should the person borrowing the money default on the loan, the co-signer has to pay the loan. So if you were to say co-sign for someone else and they didn't pay, you have to. Vice versa, if someone co-signs for you and you don't pay, they have to. So just, if you ever use a co-signer, just keep that in mind, like what kind of responsibility that is taking on in honor of someone else. And so if someone co-signs for you, don't mess that up. And if you're going to co-sign for someone, make sure you trust them. Okay. Life insurance. Some creditors require you to have life insurance to cover the loan in case you were to, say, die before you pay it off. Some creditors do not require that, but they can go after your next of kin to pay your debts. So like if, say for horrible scenario, I were to die tomorrow, my creditors could technically go after my son to pay off my debts. My student loans. Now, with student loans, I need to double check on that. The government, because they're government backed, my death might negate them. I'm not 100% certain on that. Yeah, but my mortgage, if I were to die tomorrow, there would be a choice. Either someone would have to pay off the mortgage so that my son could own the house, or the house would go away. The car loan, same thing. So my credit card bills, though, the creditors would go after, not my son. My son's only 11, but maybe my parents, to pay it off. So having life insurance, some loans, they would require you to have life insurance to cover it just in case. Okay, and then I forgot to put it on here. There's something called the Truth in Lending Act. And it refers to promissory notes. That the promissory note, I'm just going to put the PN, must contain all of the required information. So they can't, you can't sign a promissory note and then they forget to say that the interest rate could change, and then they go and change the interest rate. If it's not in the promissory note, it can't happen. Oh, yeah. Hold on. Prepayment privilege allows you to make early payments to reduce your interest total. Early payments or larger payments. So let's say my car payment is $340 a month or something. I could pay $400 a month, which puts an extra $60 a month off of the principal that I owe on the car, which makes the interest for the next month lower, and each successive interest payment will be lower. This is not all loans. Some banks or some loaning agencies don't allow you to do that. There's a prepayment penalty, and that's if you pay off your loan before the due date, you're going to get charged a penalty. And that's because if you pay it off early, they're going to miss out on all that interest they were going to charge you every month. And so the penalty is their way of recouping some of that interest. So let's say you have a 6-year car loan and you pay it off in 3 years, they're going to miss out on 3 years worth of interest, so they're going to charge you a penalty. Again, though, that's not all loans. But they have to stipulate in the promissory note. If there's a prepayment penalty, they have to say so. Just like if you're allowed a prepayment privilege, they have to say so. Wage assessment and wage garnishment. Wage assessment is you choose to have money taken out of your check and sent to your creditor to pay off your debt. So again, let's say you have a car payment and you don't feel like dealing with it, and your boss is okay with it, and your car loan agency is okay with it. You can set it up so that they'll take money out of your paycheck every week or every month and send it to the car people and make your payments for you. That's a wage assessment. You chose it. A wage garnishment is not voluntary. It's involuntary. This is usually from a court order. You get garnished wages from a court order or from like the government. If you owe taxes, they'll garnish your wages if you don't make a payment plan with them. Or if you didn't pay, like you rang up a big credit card bill and you didn't pay it, and then they take you to court over it, they'll garnish your wages, which is when they take money out of your check to pay off your debt. And you have no choice. You have no say in the matter because it's been court ordered. Okay. And then balloon payments. Again, this would have to be mentioned in the promissory note. It's when the last monthly payment is higher than the previous payments. Now, this happens because things don't work out 100% evenly. And so some loan agencies will say, okay, well, you pay your normal payment, and then next month your payment's only going to be like $48. And you pay like some little tiny partial payment. But some don't like that, and so they'll make you pay the whole leftover amount. If there's a payment and a partial payment, they'll make you pay it all together at once. Again, though, this will be in the promissory, and you need to be aware of it so that if you have a balloon payment at the end, you can budget for it. So read your promissory note. Okay, so you have any company that loans money is a lending institution. So a bank, credit union, a pawn shop, those cash advance places, those are all lending institutions. Okay, there's a lot of different kinds of lending institutions. I didn't name them all. Banks are the most common loan provider. You have savings banks and commercial banks. Savings banks are like Bank of America, Wells Fargo, the banks that you see all the time. Fifth Third, which drives me crazy because it's 5/3, not Fifth Third, but okay, anyway. Tangent. These are savings banks. And then you have commercial banks, and commercial banks are pretty much generally only used by businesses. The thing with banks is to take out a loan from a bank, you have to have good credit. It's very difficult to get a loan from a bank if you don't have good credit. I would say next to impossible without something like a cosigner or collateral. You can take out a mortgage on your home because you're putting up your home for collateral. But just to go in there and say, I would like a loan, please, and have bad credit and nothing to back you up, it's not going to happen. Credit unions also require good credit. But credit unions are members only. You can't bank at a credit union unless you are a member of the credit union. So therefore, you cannot take a loan out of a credit union unless you are a member of that credit union. Now, membership requirements, they have membership requirements, and those vary via the credit union. They're Fairwinds. I'm not sure if any of you have heard of Fairwinds Credit Union. They used to be Navy Orlando Federal Credit Union, and in order to belong to that credit union at the time, you had to be a member of the Navy. I belong to Central Florida Educators Credit Union. Originally, you had to be a teacher in Central Florida to be a member of that credit union. They've changed that now. You have to live in Central Florida to be a member of that credit union. Some credit unions have simple requirements like that. You have to live in this state or this geographical area. Some are more particular. You have to belong to this or that organization or have to work for certain companies.
I honestly don't know what my requirements are.
Yeah, it depends. Yeah, you could find out on the website. They usually say on the website. Seminole County Schools has a credit union. You have to work for Seminole County Schools to be a member of it. Um, the interest rates are lower than a regular bank, but you still have to have good credit. Consumer finance companies, these places lend money to people with lower credit, but you pay a higher interest rate. You might have heard commercials for like Lending Tree. These are consumer finance companies. Cash advance places are considered to be consumer finance companies. They are giving you a loan at about 500% interest, because usually it's only about 2 weeks long. So you might think, oh, I'm only paying $50, but it's like 500% interest because of the amount of time that you're taking out the loan. So just, keep that in mind. Life insurance policy only makes loans if you're a policy holder. You can borrow money against your life insurance policy, but only if you have whole life. Do you guys know the difference between whole life and term life? Okay, whole life is you're purchasing into a policy, and it's almost kind of like a savings account. And if I miss a payment, I can make an extra payment next month and catch it up. If I have to put it on hold for a little while, I just won't accrue anything. You're a little bit more flexible, and you're buying a policy. And if I bought like $100,000 whole life policy, when I turn 80 and I'm still alive, I can cash it in and get that money back. I'll pay a slight penalty on it, but I'll get this big chunk of money. Now, term life is a life insurance policy that you only have as long as you are making payments on it. It doesn't accrue any actual value. It's cheaper than whole life by a lot. So I can get $100,000 whole life or $100,000 term life, and the monthly payments on term life are going to be maybe half. But if I can't make the payments, I no longer have the policy and I haven't accrued any value. And then I'd have to start over. Whereas with the whole life, you're accruing value, and you can cash it in later and get money back from that. And you can also borrow against it. You do have to pay interest, but the interest rates are low because it's your money that you're borrowing against. Does that make sense? So that's the difference between the two. Whole life is preferable to term life because it does accrue value. And if you want, when you retire, you can take that money back out. Because the whole point of having life insurance is to take care of your dependents. Well, if you're, like 80 and they're all grown and doing fine, you can use that money yourself. Okay. So pawn shops. You guys have seen pawn shops? Yeah. They give you small, quick loans based on the value of the collateral that you leave at the shop over a period of 30 to 90 days. Your collateral is your personal belongings put up in exchange for a loan. If you take out a mortgage, your house is the collateral. If you take out a car loan, your car is the collateral. But if you go to a pawn shop, the jewelry or the music instrument or the camera, whatever you take has to have value. I can't take my grandma's dishes unless they're worth something. Like if they're just regular old Kmart dishes, they're going to be like, no. The amount that they give you is not the full value of the collateral. If you take a $2,000 ring to a pawn shop, they're probably only going to give you about $500 to $700 for it. And that's if you take it out on a loan. If you sell it to them, it's going to be even less. Because you can do that at a pawn shop. You can either sell your stuff or you can take out a loan on your stuff. And then the loan can be 14, 30, 60, 90 days. If you don't pay it at the end of the time, then they keep your stuff. So they can turn around and sell it. Now, if they don't sell it and you go in like 3 or 4 days late and it hasn't sold, you might still be able to get it back if you pay them plus extra. But if somebody came in and bought it, then you're out of luck. So if you do pawn things, either be sure that you can live without it, or be sure to pay it back, understanding, though, that the interest rate on this ends up being very high. Pawns are emergency, desperate kind of acts. Okay? And again, your collateral is your personal belongings put up in exchange was it, who was, okay. This table, we'll come back and forth to it, is monthly payments for $1,000 of principal. Here's some interest rates. Now there are these loan tables all over, like the internet and stuff, and it tells you if it's 1 year, 2 year, 3 year, 4 year, 5 year, 10-year loan per $1,000. So if I take a $1,000 loan out at 6.5% interest, I'm going to pay $86.30 in interest, or monthly, $44.55 monthly if it's 2 year, $30.65 monthly if it's a 3 year. Does that make sense? So the longer the term of the loan, the smaller the payment. If I take out a $4,000 loan, it's going to be $86.30 times 4,000s. Okay. So where am I? If I take out, oh, look at that, a 4,000 2-year loan. So 4,000 is equal to 4,000s at 8.5% interest. So if I come back here, here's my 8.5% interest, and here's my 2-year loan. So that makes my monthly payment $45.46. So $45.46. Now that was for a 2-year loan. So what is the total amount of the monthly payments? I'm going to take that $45.46. Oh wait, oops, I lied. My monthly payment is, this is per 1,000. I have 4 of those, don't I? I'm being lazy and not doing my math. So because it's 4,000, I have to take that $45.46 and multiply it by 4. So my monthly payment is going to be $181.84. That makes more sense. Okay, I'm going to take $181.84 times 24 because it's 2 years. And I'm going to get $452.16. Okay. And then we're going to stop for just 1 second because I think